Welcome to today's call featuring Anchor Pacific's April review of the financial markets and our portfolio positioning and outlook. Before we get started, I need to read the following disclaimer. This recorded call does not constitute an offer to sell nor solicitation of any financial product to any individual or entity in any jurisdiction. Any past performance reference should not be construed as an indicator of future performance. Any projections, market outlooks, or estimates in this recording are forward-looking statements and are based upon certain assumptions which may or may not hold in practice. Other events which were not taken into account may occur and may significantly affect future returns. Any projections, outlooks, or assumptions should not be construed to be indicative of the actual events which will occur. Lastly, today's discussions are not those of any actual client portfolios, but those of the model portfolios we use to construct and manage actual portfolios. I'll now turn the call over to our Chief Investment Officer, Steve Adang.
Thank you, Mark, and hello, everyone. Thank you for joining today's call. My name is Steve Adang, and I'm the Chief Investment Officer for Anchor Pacific Investment Management Corp. We are a Vancouver-based independent registered portfolio management firm, and we offer an outsourced Chief Investment Officer service-based solution for family offices, professionals, executives, business owners, individual private wealth clients, as well as other financial advisors. The agenda and structure for today's call is as follows. We'll have a review of April's financial markets performance. We'll discuss the economic backdrop and relevant investment themes. And we'll review our portfolio and discuss our outlook and positioning. So the month of April marked a nice rebound for most of the major asset classes, yet risks and uncertainties are abound. Measures of economic stress such as the VIX remain at elevated levels, and equities have now fully priced in a V-shaped recovery and best case possible outcomes, which contrast with our view that we are likely to be in a recession for some time and need to be prepared accordingly. After experiencing such a violent and rapid sell-off, global governments and central banks in a coordinated and swift and succinct fashion intervened into the markets to provide needed stimulus and liquidity, and subsequent to that, the market has caught a bid, a pretty substantial bid, as investors have viewed the sell-off as an opportunity to buy equities on sale, and kind of continuing on with this buy the dip mantra that has been really persistent, within the recent years, coming out of the financial crisis. And so we see that most everyone, including many investment advisors, reaching for their 2009 playbooks, which we just don't see as applicable and relevant here, given the unprecedented economic shock that we have experienced and the substantial headwinds that we are faced with. And so with employment in the U.S. Approaching its highest level since the Great Depression, we see a highly fragile and uncertain outlook with respect to the duration of the recession and what the new normal will look like for both businesses and consumers. And as a result, we remain defensively positioned. Now is no time to be a hero, and our portfolios are well structured and prepared to withstand further anticipated volatility. Now more than ever is the time that having a steady, capable, and rational hand at the controls of your financial matters and affairs will benefit owners of capital, as there's likely to be a clear division of winners and losers in every major facet of the economy. As businesses either adapt and transform, or in some cases, unfortunately, go away altogether. And more germane to this call, with respect to private client investment portfolios, as wealth transfers take place from uninformed investors to more informed investors. And so we cannot stress enough that the shortcomings of improper or false diversification are likely to be exposed soon, that all balanced risk asset allocations are far from the same, and a robust process for intelligent capital and risk allocation will set one apart in differentiating themselves and making sure that they are not the wealth transfer that I just spoke to. And so ultimately, liquidity and cash flow are likely to be the most important consideration for owners of assets, and structures holding private assets which are highly levered to economic growth, in our view and from our lens, represent too high allocations in many portfolios, and we view this as a risk and a pending storm on the horizon, and we're watching it closely. So, with respect to some of these major themes for capital allocation, as a result of this COVID-19 related economic environment, as I mentioned, staying liquid to have the ability to sufficient cash on hand to meet your anticipated requirements for liquidity, as well as anything unforeseen. In other words, to be prepared for emergencies and riding out the storm. And as well as to have cash available on hand or liquid enough securities available on hand to take advantage of fundamentally mispriced assets that are likely to rebound more quickly and more substantially. We view publicly traded assets as being significantly cheaper than their private counterparts, especially in real estate. And we are looking to be in more defensive businesses that are essential to the economy. We are looking to move further up in the capital structure where we can, when we can buy debt, for instance, at equity-like returns. And we are avoiding highly leveraged situations and companies where we view the combination of bad capital structures, highly leveraged balance sheets, and companies that are highly sensitive to economic growth as being an incredibly risky combination that we are looking to avoid at all costs. On the positive side, we are seeing some assets and strategies that are well priced presently and have a built-in margin of safety and are independent of economic growth and directional equity market movements to realize an attractive return. And for those with more flexible mandates, we are seeing set up now for interesting market dislocation opportunities in narrower segments of the credit markets, as the combination of future likely defaults and illiquidity and another unwinding of leverage is creating a backdrop and a setup for attractive opportunities to generate some significant wealth creation for those that are prepared and positioned for these opportunities. So with respect to the returns of the major asset class, it's as you can see from the slide here, equity markets were up in the magnitude of 7 to 14% in April, led by the U.S. and followed by Canada, with international equity markets lagging, and are now down anywhere from 18 to 10% year to date. High quality bonds were positive in all sectors on the month and year to date, led by global sovereign duration capture that's evidenced in the all-time lows that are now showing in the yields on U.S. Treasury bonds and bonds in Europe and Japan. And high yield benefited from liquidity provided by the Fed, returning around 5% in April, yet still is negative 8% year to date. Balanced portfolios, in other words, 60-40 portfolios primarily, composed of equities and bonds, and that proportion should be down around 7%, plus or minus 2 points on a year-to-date basis. So our balanced risk portfolio, which we run as a fully invested model of models that our actual client portfolios are managed against after adapting and adjusting for their unique circumstances, returned approximately 4.6% on a gross basis in April, and is now approximately negative 5.5% year to date. So that's in line with its reference portfolio, and more importantly, where we would have expected it to be had you told us we were going to experience this type of extreme market volatility. Further, the portfolio is well positioned going forward to withstand further volatility and collect some decent risk premiums that are independent of the future direction of the equity markets. So, talking about the portfolio specifically, its various components, and how we construct our client portfolios, I'd like to turn your attention to the slide chart that you should now be seeing. That slices our multi-asset portfolios into three sub-portfolios that are core to the portfolio, that maintain different risk exposures and targets for risk. And so we categorize those as our aggressive risk exposure portfolio, and what we call it's called capital growth portfolio, and that's usually 20 to 40% of a balanced risk client's core asset allocation. Next would be the stable portfolio, which holds moderate risk assets and is usually 30 to 60%, followed by the defensive or lower risk capital preservation portfolio, which is typically 10 to 30% of a client's core asset allocation. We also have a tactical portfolio that we run as an overlay, and this tactical portfolio holds risk offsetting exposure as well as assets that are substantially that have cheapened substantially and represent more of a near-term valuation driven opportunity. We additionally have an enhancement option for certain qualifying clients that have the ability, mainly in the form of a sufficiently long enough horizon, investment time horizon, as well as size of their portfolio, to take on a small portion of discrete private investments that are illiquid in nature, and access certain privately held Canadian technology companies, Canadian farmland, as well as core global real estate. And this exposure could be anywhere from 5 to 20% of a qualifying client portfolio. So with respect to the capital growth portfolio, as I mentioned, it is the portion of the portfolio with the highest expected return and the highest expected risk. Its objective is to provide a long-term exposure to macroeconomic growth and other equity market sensitive drivers. It holds public and private equity, and right now it is the portion of the portfolio where we have the highest degree of uncertainty, and it's the area that we are most concerned with, and accordingly have adjusted our weights to the lower end of their targeted ranges. The stable portfolio's objective is to combine some income with some growth, and in the seeking of alternative risk premiums that are independent or less sensitive to those of the overall equity markets, yet the objective of the portfolio is to generate the lower end of the return range for aggressive assets with a more modest overall risk target. And this portfolio is by far and away the most dynamic part of our process, as it's 100% actively managed. It uses different levers in the form of actively managed strategies that incorporate hedging, risk management, and other specialized sources of skill to produce idiosyncratic or unique returns. And as you can see through the next slide here, and the pie chart, that we break this portfolio down into the areas that I believe are in blue, which have exposure on the long and the short side to equities, as well as other asset classes besides equities. And so those would be our risk managed equity sub-strategies and our absolute return sub-strategies. And then in the orange, we have our directional strategies that produce a combination of growth and income, and maintain long biases towards various elements of the equity and the credit markets. Lastly, within the core portion of the balanced risk portfolio, we have our capital preservation or our defensive portfolio, whose principal objective is the safety of principal, and it's meant to provide sufficient and ample liquidity and cash flow, and act as a buffer and a ballast to the portfolio, when riskier segments of the market are performing substandard. Overall, we have low expectations for this part of the portfolio as a whole, just given the low level of present starting yields. Yet we maintain an ample portion of defensive assets in order to have safe and secure elements of the overall portfolio. So with respect to the core portfolio, as I've mentioned, we are conservatively positioned. We continue to lean in that direction. We've reduced our direct exposure to the equity markets within April, and will continue to do so, especially if markets continue to remain at these elevated levels or advance further from here. So our portfolios presently combine a combination of active and passive management. So in the norm, we are typically 60% weighted towards active strategies in a typical portfolio, and 40% weighted towards passive or indexed strategies. Given that this environment is shaping up to be one that favors more active and dynamically managed strategies, particularly for those areas that are away from the equity markets, we are moving more towards a 2/3, 1/3 balance, and with a positive bias towards active management for these reasons. And overall, our portfolios have exposure to 15 to 20 uniquely managed and purposely selected strategies where we have long-standing relationships with these managers, direct lines of communication, and high degrees of visibility and transparency into their organizations and their portfolios. And we would estimate that collectively we have over 1,000 hours spent on the research, discussion, and the monitoring of these exposures. That's assuming roughly 50 hours per manager, which is probably on the low side, and adding in that we've logged a substantial portion of additional hours in the past 90 days as we've been more active as ever in our communication, with these manager relationships. So to kind of give a high-level perspective of where we sit in each risk dimension of the portfolio and the changes that we've made, please take a look at the following table, which shows that we are underweight capital or aggressive growth in all client portfolios, and we have decreased exposure. We are to the and as a beneficiary of that underweight to aggressive growth, we are overweight stable risk assets, and we've increased exposure specifically to absolute return strategies. We are modestly, I'd say, neutral weight with capital preservation, and due to modest rebalancing and low available yields, we have modestly decreased exposure. And within our tactical overlays, we have maintained our exposure to our risk offsetting positions. So these are positions that are designed to be independent, fully independent of equity markets, or non-correlated to equity market moves, and in most cases provide positive outcomes when equity markets are experiencing sustained periods of economic decline or market price decline. And we've recently initiated our first positions in tactical, opportunistic, valuation-driven situations. So, closing, I'd like to speak to the importance, once again, I can't stress enough, needing to be as liquid as possible, and that our portfolios are structured to provide that that liquidity that we think and believe wholeheartedly will be essential to being defensive now and offensive at the right time. And so our portfolios, a typical client will have more than 85% of assets that could be liquidated quickly enough in order to convert to cash for whatever means necessary. Certain qualifying clients, as I mentioned, do have exposure in small amounts to Canadian farms, to Canadian late-stage technology companies, as well as to a best-in-class portfolio of U.S. stable commercial properties. And I did mention the market dislocation opportunity, which does exist. And for those that are dialed into this call or listening to this recording that meet the national instrument definition of a permitted client, which would be having a portfolio in excess of greater than $5 million, more or less, we do have discrete opportunities to offer solutions to take advantage of these future market dislocation opportunities centered around credit and in various more nuanced portions of the credit markets, the securitized markets, the arbitrage and relative value portions of the market. And so we welcome the opportunity to have a more engaging one-on-one discussion for anyone that would be interested in accessing some of those market dislocation opportunities. So in closing, we remain vigilant and attentive to all potential outcomes. Our client portfolios are structured with substantial liquidity as a safety net and an ability to deploy capital opportunistically when, as, and if market valuations become attractive. And we look forward to our next call, which will likely take place in late June or early July, and we will keep you updated as to the precise timing of that call. We encourage everyone to stay safe and to get in touch with us if there's anything that you would like specifically discuss. And so we welcome the opportunity to talk further with you and look forward to you joining our next market review and outlook call. So thank you again, and take care.